Assalamu alaikum. We are still talking about books of prime entry, and today we are going to talk about the cash book as one of the books of prime entry. In this session we'll talk about cash book. In the next session we'll present the bank reconciliation and the petty cash as impressed fund. When we say cash book is a book of prime entry and ledger account for bank and cash. So the difference between the bank book and the other books that we have discussed earlier, that are others were journals only, but here it's working as journal and ledger on the same time. Cash held in the business premises is called cash in hand. We have cash in hand and we have cash in bank, that we refer to it as bank. Why we don't hold all the cash in the premises? Because it's risky. It might be stolen, it might be lost in fire. So we have large reserve kept in the bank. So when we talk about cash book, it refers to both cash in hand and cash in bank. Every transaction that involves cash exchange should be recorded in the cash book. Any cash exchange involved in any transaction should be recorded in the cash book. They include cash deposits and withdrawals in the date order in which they occur. So every transaction has to be put on its order according to the date. So let's look to an example of the cash book. We start by the date, details. Then we have cash, that's cash in hand, and bank. This is the debit side. And the credit side, we have date, details, cash, and bank. Debit side will record all the receipts. And the credit side will record all the payments. We start with cash sale on September 10th. We received $150. On September 8th, we had a transfer of $530. It's from the bank to the bank, and we received a check on September 30th of $298, and of course the check will be in the bank. So transfer and check are in the bank, and cash is under cash in hand. Payments. First payment is September 4th, and it's cash purchase. We paid $25, and we issued a check of $495, and we did a transfer of $340. This is very raw example, just to familiarize you with the cash book. Cash book saves time and effort as it is both ledger and journal. All cash exchange transactions are recorded once only. Cash book helps in the following. All payment and receipts can be recorded in one page. So as we have seen in the previous example, we have the receipts and payments on the same page. Provides up-to-date record on how much cash is available in hand or in bank to make payments. We can get the balance immediately after every transaction that we enter, either it's payment or receipt, as we have seen from the previous example. Also, any recording errors can be checked against cash received, cash paid out, or the balance of cash in hand or in the bank. So we have three benefits from having the cash book. First one is all payment and receipts can be recorded in one page. Second benefit is that we can track the balance at any time. Third one is we can track errors either through payments or receipts or cash balances in hand or in bank. Knowing cash balance is very important for the business, because business needs to know that they have available cash, because if they don't have enough cash, they will be insolvent. If they can't pay their debts, they will be insolvent. And if they was not able to raise cash, it will be forced to stop trading. So insolvent, this means that they can't pay the debts. If they continue and they couldn't raise money from other sources, they will be stopped from trading. only when current account is used to make and receive payments. So when we say bank, it's a current account. There's another account called deposit account. First, we talk about the bank current account definition is an account that allows the holder to make and receive payments using check and different forms of bank transfers. The holder of the current account will be able to do payments and receive payments through checks or different forms of bank transfers. The bank deposit account is used to accept usually larger and much less frequent deposits and payments than the current account. It is used for the business savings and usually pay interest. So when the business have excess of money, they can make it in the deposit account and they can get interest on it. This is a very quick comparison between the current and deposit accounts. Day-to-day transactions, it's in the current account, yes, but in the deposit, no. Savings, not in the current account, but in the deposit account. Pay interest, not in the current account, in the deposit account. However, some current accounts now is paying interest, but let's focus on the deposit account paying interest. Provide checkbook, yes for the current, no for the deposit. Overdraw shorter term loan, yes for the current account, no for the deposit, because you can use a deposit to get long term account as a guarantee for long term loan. Transaction recorded in cash book, yes, the deposit, no. So we have 6 differences. We need to remember all of them all the time, so this will make it easier for us to distinguish between the two accounts. Most transactions involve bank transfers. Business instruct the bank to transfer money from its current account to payee account. Each instruction for transfer must include 4 things. Named holder of the bank account to receive the payment. Payee's bank account number. Transfer amount and transfer date. That's called value date by the bank. So we need the name, we need the account number, we need the date, that is value date, and the amount. We have various type of payments method. First payment method is debit transfer. That's a very simple one. It's pay given amount to payee's bank account at a given date. You give an instruction to the bank, pay certain amount to payee's bank account in a certain date. Then we have standing order. Standing order is pay fixed amount to payee's bank account on the same day every quarter or month or year. So this is like permanent instructions. Standing order is fixed amount of money to be paid to the payee account every quarter or month or year. Number 3 of the method payment is direct debit. Let's pay regular but variable amount to the payee name, to the payee account. The payee bank account receive this payment according to the instruction from the payee. The payee, each payment date and amount will be as instructed by the payee. So the payee decides for the payment, amount and date. The business is given the instruction to the bank that this payee with this account number will instruct you when the payment should be made and how much should be paid. Last thing is bank debit card. This is the usual card that we're using. Some people are calling it credit card, but it's really debit card because you are borrowing from the bank. So this is payment card used to make one-off transaction, one-off transfer. Transaction to or from deposit account will only be recorded in cash book when. So the only transaction related to the deposit account will be recorded in the cash book only when cash withdrawn from cash in hand or bank current account to be paid into deposit account. This means that the business will have excess cash either in hand or in bank in the current account to be taken to be deposited in the deposit account. This is one case. The other case is money withdrawn from deposit account to be added to the cash in hand or the current account. If the business is in need in cash and they wanted to restore some of their savings from the bank deposit, they will take the money and add it to bank current account or to cash in hand. So if we withdraw money or if we deposit money in the account deposit, in the deposit account, it will be recorded in cash. When money is paid out, either from cash in hand or from the bank, is decreased, and the payment amount is recorded in the credit side of the cash book. Let's have an example. Payment of cash purchase. The bank book here, we have the debit side and the credit side. In the credit side, we have date on September 4, we did cash purchase of $25. The opposite, if we receive money, the cash either in hand or in current bank, it will be increased. So let's have an example. Collection of $150 from credit customer on September 5th. We assume that we have balance brought forward that's $1,000 in cash and $5,000 in bank. And we received from SAMI, of which trade receivable account is $30,010. We received $150, that's cash. So we increased our cash. When cash is paid out, the amount of cash is credited to the bank book and cash balance as we have seen in the purchase. E.g., on September 9, payment of the electricity bill of $100 was done. So let's continue with the previous example. We have the $150 we received from SAMI and we paid to electricity bill $100. So our balance will be $1,050 in cash and the $5,000 in bank will stay as it is. This is how we balance our bank account, our cash book. At the end of the month, the business will balance the cash book columns of cash and bank. So at the end of every month, we have all the transactions done in the month, then we do the balances. Cash in hand, we have cash in hand and we have balance of results. If we have total debits greater than total credits, then we have debit balance and the business have cash at the start of the next month or next period. We have total debits including starting balance and all the receipts are greater than the total credits that are the payments. This means that we have debit balance and we have cash available at the start of the next period. If the cash in hand total debits equals to the total credits, which means that the starting balance plus all the receipts is equal to the payments, then we have zero balance. Cash in hand cannot have credits greater than debits because no one is willing to pay out of his or her pocket in the business. When money is finished, it's closed, they stop. They don't pay from their pocket. The contrary would be for cash in bank. We have three cases for cash in bank. We'll start with total debits greater than total credits, then we have debit balance and the business will have cash available at the start of the next period. If total debits equal total credits, it's the same thing, zero balance, there is no cash available for next month. We have to find ways to raise money. If total debits is less than the total credits, this means that credit balance of the cash, which means the bank is credit, this means that overdraw and it's a current liability. If we have cash it's a current asset. If we are overdrawn, it's a current liability. Cash discount. Sometimes it is a reduction of payable amount if payment is received before its due date. So business is encouraging customers to pay cash before they are due, and to get this money earlier, they are offering cash discounts. That's an expense for the business. It's offered to encourage customers to accelerate payments, and cash discount is recorded as an expense. While trade discount is a reduction of deducted from the invoice amount and it's not recorded. So we have two types of discounts. The cash discount that's recorded as an expense and it's reduced from the receivable balance of a credit customer who's paying earlier than the due date, and the trade discount, that's reduction of the invoice amount, is not recorded. Cash discount can be allowed discount that's provided by the business to its trade customer. So here we received from Ali discount. Ali received discount 15 and he paid 985. His balance was 1,000, but he received the allowed discount of 15, so he received 985. Discount received, the business pays trade payable at a reduced amount. So the discount allowed is the reduction of the payment of a credit customer. Discount received, the business pays trade payable at reduced amount. Here we are paying, this is the credit side of the account. We have September 3rd, 3, and we are paying to Sam, which is account 1010, and we pay him 1,970 instead of 2,000 because we received $30 as income, as a received discount. So we have allowed discount that the business is given to its credit customers, and we have received discount that's provided by the business suppliers to accelerate payments to the suppliers. This allowed discount and received discount, we are ending this session. Next session, inshallah, will be presenting the bank reconciliation and the petty cash as a sort of interest fund. Thank you.